We just got the Consumer Price Index report for January 2023, and I'll tell you, honestly, it wasn't that great of a report. Hey everyone, it's Jonathan here, and let's just get right into this report and talk about some of the things that came out of the CPI read we just got. So for the month-over-month number, the expectations was that we're going to get a 0.5% increase in January, and that's exactly what we got in the report, a 0.5% increase. And for the year-over-year number, we're expecting to get about 6.4%. And guess what we got? Exactly 6.4%. And the month-over-month number was a pretty significant increase because we did get a negative 0.1 read in December that actually got revised up to 0.1% after the initial release. Really, the big factor in this report, kind of like the last one, was shelter. And shelter contributed to about nearly half of all monthly items increased. So inflation is still staying pretty high, mostly due to shelter inflation. And the market has a pretty strong expectation that this shelter inflation will start coming down in the next couple of reports. Because generally speaking, usually shelter inflation, the CPI report, lags what's actually going on in the economy about 6 to 9 months. And we have started to see home prices fall starting in June of 2022. So if you tack on anywhere from 6 to 9 months from that, that means that in the next 2 or 3 reports, we should start seeing shelter inflation start to deflect to the downside. Now, when it comes to non-core sectors, food and energy, we saw food increase by about 0.5% over the month, while energy increased 2% for the month as well. A major driver in the non-core number was energy for this most recent CPI report. So when it comes to core CPI, we got a 0.4% read-in January, and this was mostly driven by shelter, like we just talked about, motor vehicle insurance, recreational apparel and household furnishings, and operations inflation. And some of the indexes that did increase in core inflation was used cars and trucks, medical care, and airline fares. And there was something weird about used cars and trucks that we will talk about later on in this video, so stay tuned for that. And then when it comes to the year-over-year core read-in, we got a 5.6%. And the reason why the core read-in is so important is because, like I said, it takes out food and energy, which tend to be more volatile. So we did see both the year over year for both not only core but also non-core numbers start to disinflate and continue that trend in this reading as well, which is a really good indicator because a lot of times the food and energy indexes can mess up the headline CPI number that we get. So it is good that we are seeing that continuous downtrend. So when it comes to food away from home, we did see uptick in price growth in this sector. It went from a 0.4 increase in December's read-in to a 0.6 increase, which is something that's a little concerning given the fact that we do want to start seeing disinflation in services, and food away from home is one of the bigger services on the CPI report. Like I said earlier as well, energy also did uptick. In December, we had a 3.1% decrease, and then in January, we had a 2% increase. And that was pretty much widespread in energy, whether it was gasoline or utilities or pretty much any form of energy did contribute to that. When it comes to new cars, we did actually see new cars disinflate from 0.6% reading that we got in December down to a 0.2% reading that we got in January's report. So that is a good sign that new car prices are starting to come down. So when it comes to used cars, we saw used car prices actually go down 2% in December, and we saw that followed up by a 1.9% decrease in January. And there was something interesting with used cars because we got a pretty big discrepancy between the CPI report number and the number that we got from Manheim, which is a giant automobile auctioneer. With the Manheim numbers, we've actually seen back-to-back increases in used car prices for December and January, which is pretty much in stark contrast of what we are seeing in the BLS data. And I think that there may be a reason for this. So the government uses J.D. Power data, and they usually look back about 2 to 7 years for used cars. Whereas Manheim, they use their own data, and they don't necessarily disclose what year cars they use to come up with their used car numbers. So my thinking is that Manheim probably has a lot of data on cars that are newer. So they're still used cars, but they're cars that are newer. So they probably are pulling data from models that are 2023, 2022, 2021. And typically car makers, they tend to start making their cars for next model year, the year before in the second half. And when you think about the second half of 2020, 2021, and 2022, Well, 2020 we had lockdowns. 2021 we had massive supply chain issues. 2022 we had supply chain issues, but they weren't as intense as 2021. But still, we still had quite a bit of supply chain issues. And given the fact that Mannheim is an auction house, they also tend to be dealing with cars that are repossessed, and those typically tend to be newer cars. My thinking is that because of those two reasons, I think that that's the reason why we are seeing an uptick in the Mannheim numbers. But when it comes to the BLS numbers, we're probably not seeing that same uptick, just given the fact that the government numbers look more at the older cars. I don't know. I might be completely wrong, but that's just my take on it. So when it comes to shelter inflation, we actually saw it come down from positive 0.8% in December to positive 0.7%. And the hope is that we could continue this downtrend as we start to get more caught up with the downtrend that we have been seeing in some of the private data that we've been getting. So when it comes to medical care services, we saw it go from a positive 0.3% increase in December to a negative 0.7% decrease in January. And in November, we actually saw a decrease of 0.5%. So it kind of was going down. It was heading the right direction. Then it kind of took a pause for a month, and then it's heading back down again. So that is a good sign, given the fact that medical care services is a service-related inflationary sector. And then when it comes to airline fares, we've also seen it go down from a negative 2.1% read in December to a negative 2.1% read in January. So we are still seeing a lot of disinflation in airline fares, which is a good sign because, hence, again, that is another service sector that we do want to see start to move to the downside before the Fed can finally say that they're finished with inflation. When it comes to lodging away from home, we did see that increase about 1.2% in January, which is a little concerning because that is, again, another service that we do want to see start to come down. And this was somewhat reiterated with Airbnb's beat that they announced later on in the day after the market close. So this isn't really the best data for us to see, especially given that the Fed is very focused on service inflation. So one of the more interesting subsections of the CPI report was the price of eggs. For the year-over-year number on eggs are currently up 70%. And for the month, they're up about 8.5%. And as we all know, this was caused by the avian flu. And we are starting to see egg prices start to come down. So luckily, this is probably going to be something that's very temporary. But yeah, that was something that shocked me when I looked through the detailed explanations in the CPI report. Then another shocker we got as well is that, this isn't really so much of a shocker, but it was one of the larger swings that I saw in the report, was the price of smartphones, which are down about 24% year over year and about 1.1% for January, which, it does make a lot of sense because there was a massive amount of pull forward for these items. So it does make sense that we are seeing smartphone prices deflate. And I mean, think about it. If you go and try to buy iPhone 14 right now, I think you could get the cheapest one for $800, whereas a couple of years ago, if you wanted to get like the brand new iPhone 11, it was like $1,100 minimum. So it does make sense that there is this inflation there. So pretty much all in all, this report was pretty much almost like a dud. We didn't really get a clear answer about when shelter inflation is going to start coming down, which has a very massive weight in CPI. I believe it makes up like almost 40% of the CPI read. So we do want to see that start to come down. And the hope is that within either the February, March, or April reports, we should start to see it tick down. When it comes to the Fed, what they're really looking for is the cost of services minus housing and energy. The big driver in services is obviously labor because you need the labor to execute the service. And really, with the hot jobs report that we just got recently, this data doesn't really help the Fed get a clear picture about what's going on in the service sector. We did get the sharp downturn in medical costs, but really everything else stayed basically the same. Luckily, the FOMC doesn't meet until after the next CPI report comes out and another jobs report as well. So hopefully we could get a little bit more clarification about where we are when it comes to the jobs market and the service sector. So everything doesn't necessarily fall on this report. I think one of the biggest takeaways that we can take from this report is that we are continuing to see that downtrend in the year-over-year inflation numbers, which is a really good sign that in the long term, we probably are heading in the right direction in terms of inflation. So I'd like to thank you guys so much for watching. As always, please like, share, and subscribe, and I'll see you in the next video. Peace.